Okay, good morning, everybody, and welcome to Smack the Markets. This is our 2023 year-end review and fundamental and technical trading outlook for 2024. So the session today will run for approximately an hour. As usual, I like to make these sessions as interactive as possible. So if you've got questions as we go through, particularly on the particular topics that I'm discussing, feel free to pop them into the questions box, and any sort of more general questions, just hold them to the end, pop them into the questions box, and I'll take a look at those then, and we'll work through those. So as before we get started, we've got the usual risk disclaimer. If I can just make sure that you can you're happy with this. If you can take a few moments just to have a quick read through this and make sure that you're comfortable. In brief, what we're saying is that the information that we provide during the webinar is purely for training and illustrative purposes only. We're not licensed to be able to give advice. So any sort of markets that we look at, they're purely for training purposes only. So please make sure that you're comfortable with these terms before continuing on the webinar. Okay, so let's take a look at what we're going to cover today. So we're going to take a look at the trading room performance. So that's what we've done in the trading room through the past year. We'll look at those stats. We'll compare them to last year, and then we'll compare them to the stats to date and how Smack the Markets has performed. We'll then dive into the sort of fundamental market environment for 2024. And we're going to look at some sort of forward planning on the sorts of things that are potentially going to impact on the markets and how that may well change the sort of positioning of certain sort of asset classes and the sort of opportunities that we may be able to look at for trading. So we're going to take a look at the fundamentals. We'll take a look at the technical outlook as well, and sort of combine that together so that we've got some ideas of where we're starting to focus and build our expectations for trading next year. We'll also finish up with club developments for 2024 and some of the plans that we've got going forward. So let's move straight into it and take a look at the heads up performance for 2023. So we've got people on the webinar that are not part of the club and that sort of follow Smack the Market. So just to give a quick outline of what we're showing here, these are the sort of trade heads up calls that we post into the trading room. So these are the sort of safe trades, if you like, the high probability setups that occur live, that we post out live prior to them actually triggering. And if you manage them the same way that we manage them, this is the performance that they produce. Now, of course, you'd need to take every trade that we call, every trade that we take. This is how the performance of those trades ran over the course of 2023. They produced a gain of 59% year to date. You can see that at the start we did take a little bit of a dip. I think it was about 1% in the red before the equity curve turned positive and continued to push higher. So let's compare this against last year. If we take a look at 2022 by comparison, you can see slightly different type of equity curve. So last year we had a much better start right off the start, but there was a period of time that we had a sort of a flat period where we didn't sort of make any sort of significant gains in the overall sort of progress. So performance compared to last year, well, last year we had an increase of 46%. The previous year we had 46%, and then last year we had 59%. So we've pushed on from the previous year. Now, how is that comparing to overall? We're just taking a look at 2 years there. So if we take a look at the performance over the course of the whole time we've been running Smack the Markets, you can see that we've got an increase of 389%. Of course, Smack the Market started halfway through 2018, so this is sort of representative of sort of about 4.5 years. And that sort of averages out to sort of an 86% gain per year over that period of time. So at least the equity curve is going in the right direction. And the whole idea of this is, of course, we take many more trades than what we sort of post in the trading room. But the idea, of course, is if you're sort of learning to trade, you can observe the trades that I'm taking, and you can sort of follow those if you agree with them on your own decisions, of course. And the idea is that it sort of ensures that you make a profitable trading in your trading account, which is always important when you're sort of starting out. So so that's where we are with the heads up calls for last year. Let's take a look at the stats though. Let's sort of dive into these in a little bit more detail, because this is where things start to get a little bit more interesting. And we'll compare the stats first of all from last year, 2023, or 2023, I should say, compared to the previous year at 2022. So if we look at the winners first of all, this year we've had 33 winning trades compared to 25 winning trades in 2022. The losses, we've had 13 losses compared to 17 from the previous year. So we've actually sort of practically halved or reduced the losses, increased the winners. For break-even trades, we've had 1 compared to 2, so we've doubled the break-even trades over that course of time as well. But when we start to look at the winning weeks, you'll see that we're very, very consistent there. So winning weeks, so I've included here winning and break-even weeks, because a break-even week is not a losing week. So that's the sort of theory here. You can see that through 2022 and 2023, they're consistent at 40 each. So 40 weeks of the year we had break-even or winning gains. Compare that to the losing weeks. We've halved them from the previous year. So this year, or 2023, we've had 6 losing weeks throughout the course of the year, and compared to 12 losing weeks through 2022. So can anyone remember what the biggest winning week was? Which was the best week of the year? Let me know what you think. And I bet you can't remember. Yeah, it's always difficult to try and sort of remember when, what the best returns, or when things are going the best are. And the biggest winning week we had was actually week commencing the 24th of July. So that week we had an 8.5% gain from the trades that we called in the trading room. So that was a good week. But which was the worst week that we had? Anyone get that one? That's probably more difficult, and I'll accept it's probably a more difficult one to remember, because it wasn't particularly significant in the whole scheme of things. So the biggest weekly loss that we had was on the 3rd of July, so same month in fact, and we had a 2% loss. So 2% down and 8.5% up in total. So what were the biggest winners and losing trades of 2023? So we've taken a look at overall stats, but can you remember the best trades that we had over the course of the year? That's going to be an interesting one. So let's take a dive into this and take a look at what they are. So the first one is, which was the biggest loser? How much did we lose on the biggest losing trade of the year? You must get this. You must get this. If you don't, go back and read the manual. It is a trick question. Yeah, they should all be capped at 1%, of course. And well done for getting that, by the way, those people who did. Or 1%, or whatever your risk is. I know some traders will trade with 2% or a particular amount, but it's whatever your risk is per trade. It's 1% or that percentage of risk. So all losers capped at 1% or that minimum risk. So the big question, I suppose, is what is the biggest winner? And we want to make sure, obviously, that the winners are bigger than the losers. So which were the biggest winning trades of 2023? Yeah, well done, Michael. Well done, Michael. Spot on. Every loser is the same. So sometimes it's difficult to remember back to the good trades and the big successes. And this is why, one of my big tips is to keep a record of your best trades, your best 10 trades. Keep them handy and review them regular. Don't put them away. Keep them on your trading desk and review them regular. Because just with human nature, we tend to remember, the losers, but we tend to forget the winners very easily. So you could have had dollar CAD, and I see some people actually did mention dollar CAD there. So and dollar CAD was a good one, actually. In fact, and I believe this one I was actually in Portugal, trading from Portugal when we got this trade. So it was a 4.5% gain on dollar CAD, and it just proves you don't need to be at your trading desk all the time. Comcast. We could have had Comcast. We had 3.5% gain on Comcast on the 27th of July. No one got that one, by the way. Looking at the ones that have come in. Kiwi Swiss, no one got that one, which was the 4th of July. Sorry, the 16th of October. That was a 4% gain on that trade. Gold, we had gold, took 3% on gold on the 17th of October. And I did see a couple of people mention Admiral. So that's a recent one on the 27th of November. But we took 3% on Admiral. It wasn't, it probably wasn't the sort of biggest gain, but it was reasonable. So the biggest winners, and I don't think, well, in actual fact, no, I do see some people have got these. Some people have got some of them. So the biggest winning trades that we had for 2023, there was actually joint 3 of them. So we had Aussie yen on the 5th of June. So we took 5% on all of these trades. Apple on the 20th of July, that was 5% as well. And GE, General Electric, we had a 5% gain on General Electric around the 24th of July as well. So those were the 3 biggest winners, and we'll take a look at those and just remind ourselves of those trades in a few moments. But one thing that we ought to do is we started to introduce stocks into our trading methodology. Now, we went through the training for introducing stocks and the specific things that we're looking for, and particularly about not so much just the technical setup. The technical setup's the easy part on when we're looking at stocks. It's more about the timing and whether the timing is right. There's a lot more things that we need to consider. So we started to introduce stocks into our sort of trading room performance about midway through the year, once we'd sort of completed all the training. So we had 7 trades on stocks, 7 trade heads up trades, I should say. So these were trade calls through the remainder of the year. Now, 5 of those were winners in total. We had 1 loss and we had 1 break even. So not a bad return, particularly when we're just starting out introducing these. So let's take a look at the trade list, because it's not a significant amount. So we had General Electric, which was a 5% gain on the 26th of May. We had Apple, which was our 5% on the 19th of June. Comcast, which some people actually mentioned, which was 3.5%. That was on the 18th of July. We had Alphabet. Now, Alphabet was a loss. So that one, I think that was actually a loss on the same day, in actual fact. So I need to go back to the drawing board on that one. Can't have that, can we? But that one didn't play out. We also had General Electric again. So we actually took several trades on General Electric. And it's actually a trade that that I'd been in for a long time, actually, right from the beginning of the year. But this was an additional trade after we'd closed out this earlier one. And this one we got 1% on. If you recall, this trade, we weren't planning to take 1%, but would never be planning to take 1% on a stock. But the market, once the trade was triggered open, the market didn't really perform the way that we expected, and we decided to just close out at once it got to the first target and gave us a 1%. We decided to close out, and it was a good call to do that, because had we have not done that, it would have turned into a loss. So Admiral, we took 3% on Admiral in October, and Centrica was the break even that was also in October as well. So Centrica actually went on to sort of first target and slightly beyond first target, but rather than close out, the market structure was still good. We're still expecting the Centrica to continue, and in fact, it came back. It allowed us to move our stop to just about break even, and but it came back and took the stop out. So over the course of all the stock trades that we've had over the course of 2023, as I say, it was only sort of an introduction, and it only really started in the sort of 6 months of the year. We'd taken a total of 16.5% from those stock trades, with of course one loser. So let's remind ourselves of the top trade setups and those big trades that we took. So again, this is the, when we've taken good trades, when we've got good trades, or successful trades, I should say, then it's always a good idea to keep these, to keep a reminder of these, and remind ourselves of what we were doing right and what worked, what was successful. With Aussie yen, it was all about a swing long position, and the usual methodology is that we're looking at getting into a swing position on a macro move using lower time frames. So we're drilling down to, our particular style is we drill down to lower time frames to get a tight entry and benefit from a macro move on these higher time frames. And that of course just means that we get more reward to the risk that we take on the setup. On this particular trade, we can see that from the monthly chart here, the market started to break out and see another leg higher. The daily, the market sort of broken out through a market structure level, and we got a bit of a pullback. Taking a look at the 4-hour chart, you can see again that the market has pulled back into another structure level that we'd got on the 4-hour time frame, and finding support there within the context of now what looks like the start of a new trend. So the setup was on the 60-minute chart. We waited for the breakout here. There's just nothing really here to get sort of positioned. And I remember when we were looking at this, there was two options. One was to take an entry above the high of this sort of consolidation, but then the stop would have been underneath this pivot point and right the way down underneath these lows, and the risk on the trade would have been a lot wider. Instead, one of our typical tactics is to wait for the market to break out and then pull back, finding support at the original breakout level, and we capture the evidence, the first evidence that we see here of buying action. So the stop was actually supported by a pivot point on the day, and that was the technical setup. And this is how the trade played out. So it did continue to push on in the right direction. It took its time. We got here in for a few days, and as you can see, the market continued to grind higher. And as the market continued to push higher, we moved our stop up into new technical places just to peel off the risk, lock in more profit until the market reached our objective. Now you can see that the target, where you can see just at the top end of the chart there's a blue line. That was where the ultimate target, that's where the market, we were expecting the market to move to. The grey line here is our fifth target. So we got out just before the market sort of hit the level that we were expecting it to hit. So so 5 targets on Aussie yen. The next trade was Apple, and this one a stock, of course. Again, we got a decent trend here on Apple. We waited for a pullback, and we got in on this area here as the market sort of pulled back, and we got a bullish candle there, evidence of strength. And we bought the market just as the market broke above the previous day's high. There was a number of things why we took the stock when we did. It wasn't just about a technical setup, it was all about timing as well, and we were expecting this market to push on, or stock to increase, which it did, of course. So this was the original setup here, and you can see the market sort of moved higher. Again, we did the same thing. We actually moved the stop locations up to lock in the risk, and also protect the gains. And this was the total 5th target, and that's where we closed out. So again, another winning trade, or the first, probably the best winning trade that we had on stocks. The next one was General Electric, and this screenshot here is a little bit on the late side. You can see the setup that we took here on. In fact, you can just see where the orders got triggered, but the entry was the pullback and the rejection here of or establishment of a higher low within the context of long trends. General Electric was a trade that a market that I'd been in for a long time anyway. So I got in back here at sort of January, February time, back in here. So we were sort of adding to this as it was going. That was the daily setup, and the market, we held the market into earnings, and you can see here that the market gapped up, hitting 5th target, and this was an earnings related gap. So at this point here, when we had an exhaustion in the market, we decided to close and book the profit, because what happened afterwards was the market closed the gap. It came back right the way back into all of this sort of congestion zone. So if it's on the table there, we might as well take it. We can always get back in again, preferably at a lower price. So they were the best trades, or the biggest trades that we had through 2023. Hopefully you've remembered some of those, and I know some of you actually benefited from those very nicely. So let's take a look now at the environment going forward into 2024 and do a bit of trade planning. So we'll start off with the fundamental environment. Now 2024, it starts with a number of big themes that could have some major impact in shaping the financial environment, and I'm sure they will. You know, in previous years, we've had all sorts of things like COVID and unknowns that have been impacting on the markets. This year, things are again a little bit different, but we pretty much know what the big themes are going to be, and it's how those are going to impact on the financial markets. The big one, of course, is inflation. We've had huge amounts of inflation around the globe, that inflation is now starting to come to an end. Western countries are starting to get control of the inflation, and it's starting to reduce. So throughout the most sort of G7 countries, inflation is reducing. It's expected to reduce in 2024. So how is that going to impact on the markets? Well, of course, we're going to see interest rates that are going to be impacted by inflation. So we know that as inflation reduces, interest rates are widely expected to have peaked. They're actually expected to reduce now in the US and the EU, as well as sort of other countries as well. The US probably ahead of the game against the other G7 countries, and that's probably going to be quite important as we go forward. Also, the other big thing that impacts and that is all connected here is bond yields. Bond yields will be reducing as interest rates reduce. I mean, of course, we've got dollar-related bonds and high interest rates on the dollar. Then, as those interest rates decline, well, of course, the bond yields are going to decline as well. And so we expect to see the implications of what lower bond yields are going to have on the markets as well. So how does this sort of impact on us as traders? Well, for currency traders, which we trade a lot of currencies, the interest rates are the biggest thing that directly impacts the strength of a currency. And as we see a change in an interest rate for a particular country, particularly the world's biggest economy and the world's biggest currency being the US dollar, when we see significant moves in the dollar, that's going to have an impact on other currencies that it's priced against. Now, those changes, of course, are going to that repricing is going to mean that there's going to be opportunities. We're going to see some decent moves in currency markets, and that, of course, gives us trading opportunities as we trade one currency against another. We'll see a little bit more of this when we take a look at the technical outlook as well. Now, we haven't just got the sort of financials, that impact on the markets. There's also sort of political tensions, and these days, unfortunately, conflicts as well. We've still got the Russian-Ukraine war that's going on. We've still got tensions with China, particularly China over Taiwan. With new one, of course, we all know about is Hamas and Israel and the war that's going on over there. Now, I think broadly, these conflicts, these situations are broadly priced into the markets. So the markets know about the Russia-Ukraine situation that's been going on for some time now. So it's it's sort of priced in as to sort of where we are now. Any kind of escalation of these situations involving more countries, or if things escalate, if there's sort of further things that happen between China and Taiwan, for example, then that's going to be bad news for risk assets. Risk assets, assets like equities, and what that will do is it will impact on risk assets, and we'll find that markets like risk havens will benefit from that. We've also got commodities. Commodities, great for trading. Oil, gold, silver, copper. In the trading room, we've traded a lot of copper over the past sort of 18 months. A lot of gold as well, and I like silver too. But these commodities, they're sensitive to changing political and particularly sort of conflict tensions. We know that energy, sort of oil and gas distribution, that sort of impacts on oil prices. We've got a situation at the moment with in the Red Sea, which we're probably all aware of, that Yemen sort of trying to restrict ships and attacking ships going through within the Red Sea, and that's having an impact on oil and gas distribution, and that's what is the reason why we're starting to see a bit more supported prices in the oil market at the moment. Now, interestingly, when you look at what the big banks are suggesting, the likes of Morgan Stanley, they're not expecting that situation to have a massive impact on the price of oil. But certainly at the moment, it is having an impact because we're starting to see that evidence. So, if shipping has to get redistributed a longer way round to avoid that sort of part of the sea, then it's going to have an impact on prices. Things like metals, particularly sort of gold and silver, these reflect sort of risk sentiment. So when we see situations where you've got sort of an escalation of sort of political tensions or sort of conflicts around the globe, then money tends to get moved into safe havens, and gold, silver is a popular place, one of the safest places for money to move to, along with other things like the US dollar as well. Copper, although it's a metal, it's a little bit different to the likes of gold and silver, and it tends to reflect more of the world economic strength. Now, China is the biggest user of copper. It's the biggest importer of copper. So what the strength of Chinese economy is a massive impact on the price of copper. If China booms, they'll be using a lot more copper. The demand for copper will be high. Copper prices tend to follow suit. If China is not doing so well, which the economic numbers so far have been pretty much on the fence with this, then that's been sort of like curtailing some of the higher prices with copper. So direct sort of correlation, not so much related to sort of risk sentiment, more related to world economic strength. So, if conflicts continues, or particularly if they escalate, then that can have an impact on the commodity prices that we've just been discussing. You can get commodity price inflation. We know that actually from going back a little while with when the start of the Russian-Ukraine war started. Oil, gas increased dramatically. You also find that if there are sort of conflicts or an escalation in conflicts or tensions, it tends to be a bad news for risk assets. Now, that means that equities, you're likely to see equities sell off and the money come out of equities and move into safe havens. Safe havens like gold, the US dollar, even if interest rates are low or coming down, if dollar is being used as a safe haven, then it's going to, there's a lot of inflows into the dollar, it's going to rise. You go back to take a look at sort of the COVID years, for example, when there was big risk and big risk off moves, the dollar appreciated dramatically from that. So, again, it's a good indication of how these different markets can benefit from different things taking place in the world. So, potential market impact and trading opportunities. Well, we know that the path is set for US rates to decline in 2024. Mr. Powell, the chairman of the Federal Reserve, has already said that. It's widely expected now that the markets are expecting it too. So we're going into an environment where the dollar is going to be declining, or the dollar, I should say, interest rates for the dollar are going to be declining in 2024. So that means that the dollar itself is going to become weaker. It's the interest rates for the dollar is going to become weaker. And there's potential rebalancing now against the G8 Forex majors. So the dollar, as I said, is the one that is ahead of the curve. So if you've got reductions in interest rates in the US before we start to see that in Europe and the UK and other, then what you're going to find is you're going to find that the dollar is going to weaken. You're going to find that the euro is going to strengthen against the dollar, and markets like the pound are going to strengthen against the dollar as well. So again, just sort of thinking in terms of where those moves and where those potential trading opportunities can stem from. If we get lower interest rates in the US, then we're going to get lower US bond yields, of course, as well. Now, lower bond yields benefits stocks. They benefit companies. A lot of companies use the debt, use bonds for debt. So you tend to find that particularly technology stocks, so the NASDAQ particularly, when bond yields come down, it benefits indexes like the NASI, and it also benefits the big technology stocks, which tend to be heavily debt ridden. So these companies benefit from that. We saw an inverse of this, of course, through this year when the bond yields were increasing to dramatic, well, very, very highly. They went up to sort of 5% plus. 5% plus in bond yields. It started to impact on the NASDAQ, and you could see that as a direct correlation day by day as that was taking place. So with lower bond yields, this should benefit markets, stocks, and particularly markets like the NASDAQ. So lower interest rates, generally positive support for equities. You also find that dividend and risk returns become a lot more favorable, of course. If we think in terms of equities now, if the interest rates, let's just think, for investors that have got a chunk of money at the moment, in most places, certainly in the UK, you could put it into an overnight deposit account, which is safe as houses, and get about a 5% return on it for doing nothing. So that's 5% risk-free. So if you want to put your money into stocks, then those dividends have got to pay out more than 5% for it to be worthwhile, and the returns that you get on your stock investments need to be more favorable than what you can get in deposit accounts as well. Now, of course, if the interest rates decline, then it means that the dividends become more attractive. It also becomes, that the potential returns that you can get from investing in stocks becomes much more favorable. So lower interest rates tends to help stocks to increase and become more desirable. There's also the potential for support for gold and silver. There is a direct correlation between the US dollar and gold and silver prices, and it's because gold and silver is priced in dollars. So the lower the dollar goes, and of course we're expecting the US dollar to potentially sort of weaken. It's one narrative that the US dollar could weaken with a reduction in interest rates, then that could well support prices for gold and silver, and we could see higher prices for these markets going forward. Now, markets price in 6 months ahead of time. That's always the sort of case, or about 6 months. Now, we know that there are at least 6 quarter-point interest rate cuts already priced into the US markets, with the first cut predicted in March 2024. So that's what the markets are expecting. Now, if anything happens that changes that narrative, so anything geopolitical, anything sort of fundamental, inflation stays particularly sticky, or it starts to increase and Fed members start to reconsider the interest rate sort of dot plot, or when those cuts are going to come and the number of cuts, anything that changes this narrative is going to have an impact on the markets. It's going to change the status quo as to what is priced in already. So it's, it's always a moving target. We know what the market's expecting, but whether that actually happens, again, and there's a lot of time between now and March for things to potentially start to change. So just to take a look at sort of how geopolitical and conflict tensions could impact on the markets. Unfavorable developments, again, can impact on the general risk sentiment. So we sort of mentioned a few of these things already, but the US dollar, that's a risk haven asset. It's a popular place if you've got a chunk of money that, and we're not talking about people like you and me that have got a chunk of money that we put into a bank account. We're talking about people that have got a lot more than that. They move their money around to the best place, and of course, if there are conflicts, if you need to move your money into a safe haven place, then you want to move it into the safest currency, the safest country, the strongest country, perhaps assets that that you can that are universally acceptable. So things like the US dollar is a risk haven currency, even if you've got interest rates declining. If you've got political tensions and conflicts which people want to protect their money, then the dollar is a place to go to. Gold is another good place to go to. It's the biggest risk haven asset. So we've already talked about the sort of potential that gold could benefit even from a declining dollar. Equities, you tend to see outflows of money from equities when there are sort of geopolitical sort of escalations and conflict situations. Also, we sort of touched on gold, oil, gas, energy distribution, supply risks. We've seen this through the sort of COVID years as well, that can impact on these assets and on these commodities, and again can create opportunities. If we hear about these things, these markets move. These are the markets that move. Prices are also susceptible to tensions, to trade tensions, and we've seen this quite a lot. We subscribe to the professional traders newswires here at Smack the Markets, and I get a lot of information, a lot of internal sort of background information that you don't get through the general news media. And unfortunately, the sort of China, particularly the China and Taiwan situation, the US is sort of caught in the middle of as well. It's not, it's not. There's a lot of stuff going on. Let's just say there's a lot of stuff going on. It's not particularly pretty. But you've got the sort of trade tensions, which I'm sure we must all have heard about now, between sort of US and China, particularly technology. There's been sort of restrictions on each country sort of selling and releasing sort of certain technologies to the other. The situation between China and Taiwan, the reason why China wants Taiwan is because Taiwan is where the majority of the world's semiconductors and chips are made, and that is a massive powerhouse there. And if that falls into someone else's hands, then that could sort of impact on other sort of countries, perhaps. So there is a lot going on, between these, and those sort of tensions sort of seem to be escalating over sort of recent months. So, as we said, impacts on risk sentiment can have an effect on major sort of asset classes, but overall, if something big happens, then expect a broad range of assets and markets to be affected. What I mean by this is, of course, if when there's big shocks, then sort of everything gets shocked. But it's useful when these things happen. The traders, the banks, the trading houses, the professionals, they know where the go-to places are, where they start to position themselves to benefit from that. So we've taken a look at the sort of fundamental picture. Let's take a quick look at the technical outlook now and where we are with the technical charts. Because again, just thinking in terms of the fundamentals and taking in, thinking of the sort of themes that we've been looking at, as traders, we want to sort of combine that with the technical charts because we're technical traders and we want to be able to sort of get positioned using sort of the technical techniques and price action. So the dollar, if we take a look at the dollar here, you can see where we are. So this was last, this was sort of since 2002 to 2003, and this was sort of the previous year. So you can see the coronavirus sort of rally that we had in the dollar. The market's been sort of stabilizing and bouncing off the 100 level. And more interestingly, recently, we're seeing sort of quite a significant sort of sell-off in the dollar. We know interest rates have peaked, so interest rates, on the path to reducing. And you can see that the dollar is now starting to establish a short trend now, and it looks like, well, we're almost certainly heading back towards the 100 level. The big question here, you got 100, which has been supported 3 times now through 2023. Once that goes, we could be heading back down to these sort of lows down here, historical lows going back to sort of 21. So there is potential here for the dollar to decrease fairly significantly, and it could be that we're just sort of at the start of a move here. Remember that when we're looking at these, we're looking at currencies. We're looking at one currency against another. So it's not just the relation of the strength of the dollar, but it's also looking at the relation to compared to another currency. But as we can see, there is plenty of potential opportunity to the short side for the dollar. Thinking in terms of the dollar, if the dollar declined, then we said that risk assets like gold tend to push higher. You've got here a level here on gold. In fact, if we just take a look back on gold, you've got, I see here an inverted heads and shoulders. I'm not sure if you sort of see that pattern. I see here, the market sort of tested these lows here. You look at this level, can't quite read that, 1850, I think. So you've got a low, equal low, then you've got a lower low here, then you've got an equal low here, which surprisingly lines up with the previous. So you've got a shoulder, a head, a shoulder, and you've got here, 2 shoulders, head, inverted heads and shoulders, and the market's breaking out to the upside. So you can see that we've got significant levels here around that 2050 area. Breaking through here, we've got trading windows up here to the top end, and honestly, when we get through there, we're into sort of some free space. So as the markets sort of break out of this, it becomes freer and freer and freer. But the path here looks to be lower dollar, higher gold. Taking a look at the NASDAQ and the US stock markets, these markets again had extremely good moves over the past couple of months, and this is based on the fact that interest rates are expected to have peaked and expecting to decline next year. Stocks increasing now. I still think that there is plenty of further through 2024. The fundamental environment looks very positive for stocks, and I wouldn't be at all surprised as interest rates unwind, bond yields unwind. I would expect stocks to that to be supportive of stocks to continue to push higher. Looking at the way that these markets have finally where they're sitting at the moment, of course we expect that there should be some sort of pullback at the moment. They're quite extended. They've had a very good run. They don't always run in one direction all the time. If you look at the rally that we had going back a couple of years, there's always going to be pullbacks. So the market predominantly looks like it can benefit for higher prices here, and the same with the S&Ps. The S&Ps have rallied up we got into a level here at 4,800. Getting through there just breaks all the resistance, and there's no more resistance in the way for 6,000 to get tested and maybe beyond. So again, we need to be careful, because at areas where we are, it's a good place for the market to retrace, and a good place for a pullback. But they're all looking particularly strong at the moment, and the same with the Dow as well. I mean, I took these screenshots yesterday, so I know the markets have been a bit choppy overnight, but they're broadly the same, and the Dow just a stone's throw away from 38,000, and getting up towards these sort of all-time highs. So again, fueled by lower interest rates, potential of lower interest rates, fueled by lower bond yields, and these markets are pushing higher. So I think that these themes that we're starting to see now are likely to continue. The fundamental environment that we've just discussed supports the start of these moves that we've started to see, and I think sort of general sort of trend. We can see that there are opportunities technically for these trends to continue, but also they line up with the sort of fundamental picture as well. So in summary, just to sort of tie this together, in 2024, it's shaping up to be a very interesting year for traders. We can expect currency market repricing as the US interest rates decline. We're going to sort of see that. Now, if interest rates decline, we can see supported prices for gold with the lower US dollar. So we can expect sort of gold and silver highly correlated. So silver will move higher within tandem with gold as well. And again, supported stock markets as well. Lower interest rate environment supports stock markets too. So whilst we've got no crystal ball, what we have got here is the fundamental picture is positioning itself for some interesting moves and continuation of some of those trends that we've started to see in the technical environment on those charts that we've just taken a look at. So one thing that is certain, and that's when markets move, creates opportunities for us as traders to profit from the price action. And I say there in either direction, because we don't have to be trading just in one direction. As traders, we can trade in both directions, and that just gives us plenty of opportunities to be able to trade the markets when they're going up, and also trade the markets when they're going down as well. So hopefully that's been quite interesting, and maybe given a few sort of pointers as to where we can start to sort of focus our potential sort of opportunities into 2024, and how the things that are setting up in the world environment at the moment, and how they're going to potentially impact on the markets in 2024. Let's just take a quick wrap up of new club developments which are coming in 2024 as well. So next year, I'm going to be running a exclusive new trader group. So this is a small, carefully selected group of traders. So I need some dedicated people for this, who really want to learn how to trade. It's going to be a very small team which I'll take under my wing, and we're going to teach you basically everything that we do with Smack the Markets. That's all the trading strategies and the techniques that we use to read price action and trade the forex markets, the index markets, and commodity markets as well. So it's a long program. It's not something that is going to be a weekend course or a couple of weeks and then you're left on your own. I never train people like that, because you need more. Everybody needs more than that. So this is personal training, it's personal coaching, and it's for as long as you need it. And it'll also mean that once you've learned the techniques, or for these lucky people, when they've learned the techniques that we use, then you will be able to you'll be entered into the trading room as well. We've also got member training. So this obviously for existing members. We have training sessions, periodic regular trading sessions, along with monthly trading clinics. We've got a next session. We said January, didn't we? 2024. So that's the next session that we're going to be focusing on. So look forward to that. It will be towards the end of the end of January. There's going to be a bigger focus on stock trades through 2024. Obviously, we went through the training, and that was we introduced stocks. We're also going to we've got fairly successful hit rate on stocks this year, so we're going to continue that and expand on that next year. And we also have a new Smack the Markets apprentice, so a position. So I'm looking for somebody who to work with, someone who wants to work with me and trade with me, and also to help run Smack the Markets as well. So that's a little position that I'm looking at sort of filling as well. So if you're interested in any of these, I haven't actually launched anything on these yet. There's only going to be a few positions here for the trader group. There's obviously only going to be one position for the apprentice at the moment. But if you are interested, then the best thing to do is to get in early and contact me and let me know of your interest. The best way to contact me is through the website, and if I drag over my screen here, so you can come to the website and you come to the more contact us tab, and you can send us a message in here and let us know your interest, and we'll arrange to have a discussion and see if this is suitable for you, and whether we're suitable for you or whether you're suitable for us. So we can have that discussion. Okay, so that really brings us to the end of the webinar today. Just to give you a bit of a heads up on the schedule. So obviously today the UK markets close midday. Kiwi markets are closed already. The US markets are going to be open for the remainder of the trading day. I'm not sure of the liquidity in the markets this evening or the afternoon for the US. So what I'm going to do is we're going to check. I'm going to run the US prep. We'll look at that, but I'm going to sort of start to wrap up then around sort of early afternoon. So we'll be closing early afternoon, or closing the trading room early afternoon today. We'll reopen on Tuesday, the 2nd of January, and be back to normal then. But remember, trading in between Christmas and New Year, Forex markets will be open. Some futures markets will be open. Liquidity is going to be extremely thin, so be extra sort of cautious on those price moves, which can be a bit erratic. So just to sort of finish up, again, if you've got questions, I can see there's a few coming through, but if you've got questions, pop them into the questions box now, and I'll take a look at those before we wrap up. Just want to say thank you very much for joining us for this year's year-end review and sort of forward planning sort of webinar. Hope you found it very useful and interesting. For everybody, I just wish you a very, very, very good Christmas and a smashing New Year, and for all the members on the webinar today, of course, I look forward to working with you and trading with you next year as well. Okay, so let me just take a look at some of these questions sort of coming through. Oh, thank you very much, Stephen. Yeah, have a great Christmas too. Cheers, Neil. Who's Santa Claus? Oh, Martin. Happy Christmas, Martin. Excellent. Yeah, thank you very much, Michael. Super. Yeah, so I'm gonna this is being recorded. I'll put this on the website to for a period of time, so it will be available to review on the website. Excellent. Okay. Yeah, if you are interested in the it's the best thing to do is if you're interested in in joining the trading group. It's something I haven't actually done before. I've run training courses um, for Smack the Markets members, um, but I haven't done anything since running Smack the Markets. I haven't done anything for uh, brand new traders. So this is something that's sort of quite exclusive, and it doesn't matter where you are. You know, if you've got some experience or you've got no experience at all, it doesn't matter because we're going to be going through everything. So yeah, so just let me. We'll obviously just contact me, send me a message, and we'll have a chat. Okay. Um, super, super, super. Okay, so I think I've got everything there. Let's wrap it up. Have a great Christmas. Have a great New Year, everybody, and look forward to speaking to you in the new year. Thanks, everyone. Bye for now.